Welcome back to the Deep Dive. It is Wednesday, February 4th, 2026.
Wow.
I know, can you believe we're already this far into the new year? Whether you're stuck in traffic, prepping for a morning meeting, or just, staring at your banking app wondering what is going on, we have a massive stack of research to get through.
It really is a fascinating moment. We're seeing a financial world that's, well, it's in a state of transition.
No.
We've got these huge rallies in commodities, especially gold, which was the absolute story of late 2025.
For sure.
But at the same time, the tech sector, which seemed, invincible for years, is finally starting to show some real cracks.
Exactly. And we aren't just staying high level today. We're going to zoom in on a specific, really gripping case study. It's a banking crisis unfolding in South Asia, specifically Bangladesh,
Yeah,
that honestly reads like a thriller about systemic risk.
it really does. And the mission for this deep dive is to connect those dots. We want to take these big global investment trends for 2026, all the macro stuff, and link them directly to the nuts and bolts of your personal money management.
So just to orient everyone, we've got a pretty diverse stack of sources. We're pulling from global investment outlooks like Amundi and PensionCraft. We've got insights from financial educators on YouTube like Kai and Nomad's Diary.
And for that banking deep dive, we're looking at some heavy research from the Policy Research Institute and the Asian Development Bank. It's a mix of the 30,000-foot view and the ground level.
So let's jump in. The global view. I was reading the Amundi Outlook, and they have this phrase for the 2026 climate: keep it turning.
Keep it turning, yeah. It's a great phrase for what they're calling a controlled disorder.
Control disorder. I like that.
It basically means the global economy isn't collapsing, but growth is definitely moderating. We're in a transition phase. We're not seeing that explosive post-pandemic growth anymore, but we're not falling off a cliff either. It's a delicate balance.
But let's talk about the elephant in the room, or maybe the seven elephants.
Yeah.
The Magnificent Seven tech giants. For the last few years, the authority's just been buy AI, buy tech, get rich. I saw a stat in our sources, I think from Kai, that if you had put 10 grand into NVIDIA 10 years ago, it would be worth something like $2.85 million today.
That is just historic wealth creation. It's the kind of number that makes you want to go back in time and just shake your younger self.
But, and this is the big question, is that party over? Because looking at the data from December 2025, NVIDIA was down over 10%, Microsoft down about 5%.
And this is where it gets interesting for 2026. The narrative is starting to wobble. Capital expenditure in AI and defense is still driving markets, sure, but valuations in the U.S. have gotten incredibly stretched.
Hold on, though. We've been hearing tech is overvalued for like 5 years. If I listened to the skeptics in 2023, I would have missed out on an NVIDIA doubling. Why is this time different? Why should I believe the wobble is real?
That's the fair pushback. I think the difference now is the concentration risk and a earnings reality check. The market is, waking up to the fact that these companies make up about a third of the S&P 500. A third.
Wow.
And both Amundi and PensionCraft point out that the Shiller-Cape-E ratio, which measures if a market is cheap or expensive based on 10 years of earnings, is flashing bright red for the U.S.
Okay.
It's at levels we rarely see without a correction following.
So the easy money has been made.
I think so. The growth at any cost phase seems to be ending. Now, investors are demanding to see how all this AI spending actually turns into massive profits, and that timeline is getting stretched.
So if the money's moving out of big tech,
Yeah.
where on earth is it going? Because looking at the charts, the answer seems to be yellow and shiny.
Gold. Absolutely. Gold was the standout asset of 2025. It rose nearly 60 to 70% last year.
That is insane for a rock that just sits there. Kai mentioned its market cap is now $31 trillion. It's way ahead of any single company. But usually, gold goes up when people are scared of inflation. Inflation's down, so what gives?
This is the key insight from the Amundi report. It's not just retail investors buying coins, it's central banks, and this is a really big deal.
Which central bank?
Mostly in the global south and the east. They're aggressively swapping U.S. Treasury bonds for physical gold. They are effectively saying, we don't want our national savings tied to the U.S. dollar's performance anymore.
So it's a strategic decoupling.
Exactly. It's geopolitical. If you're worried about sanctions or you're worried about U.S. debt levels, gold is the only asset that isn't someone else's liability. Amundi actually has a target for gold hitting 4,200 in 2026.
That is a massive structural shift, not just a short-term trade. Yeah, okay. So tech is wobbling, gold is rallying. What about the cost of money? We spent all of 2024 and 25 obsessing over the Fed.
The obsession continues, but the direction has changed. The Fed is cutting rates. They were expected to cut 25 basis points in December, with more coming this year. But here's the curveball. The Bank of Japan.
Japan. They usually do nothing.
Not anymore. While the Fed is cutting, the Bank of Japan is the big outlier. They're hiking rates.
Why does that matter to me?
Because for decades, investors have borrowed money in Japan for free because rates were zero and invested it in the US or Europe. It's called the carry trade.
Right.
If Japan raises rates, that free money isn't free anymore. That money has to go home.
Which could cause some chaos in global markets.
It certainly can, and that's why if you're looking for value in 2026, the sources suggest looking away from the expensive U.S. market. PensionCraft highlights places like the UK, Japan, and emerging markets like Brazil and Mexico as being much cheaper relative to their earnings.
Okay, so the macro view is tech is expensive, gold is rallying for geopolitical reasons, and the interest rate game is getting complicated. Now, I want to pivot.
Where are we going?
We're going from the overvalued optimism of the U.S. market to a place facing the exact opposite problem, a crisis of hidden pessimism. We need to talk about the banking crisis in Bangladesh.
This is a heavy topic, but you're right. It's crucial for understanding systemic risk. The sources we have, specifically that paper from the Policy Research Institute, paint a very concerning picture.
Let's look at the numbers, because there seems to be this huge difference between what was reported a few years ago and what's happening now. It feels like a bad magic trick.
It's a huge discrepancy. If you looked at official reports from, say, 2020 or 2021, non-performing loans, or NPLs, basically loans not being paid back, were around 8 or 9%.
High, but manageable.
Exactly. But the new reality, drastically different. According to Kantar Kul Islam's research, by the end of 2024, the official NPL ratio hit 20.6%. But, and this is the really scary part, if you include stressed assets, which are loans that have been rescheduled to avoid being called bad, the number approaches 45 to 50% of total loans.
Wait, pause. 50%. Half of the entire loan book in the banking sector is stressed.
That is what the data suggests.
How does a banking system even function like that? And more importantly, how is it hidden for so long? How do you hide half a country's debt?
That brings us to the rescheduling trap. You asked how loans disappear from the bad list. It's a process. It's called evergreening.
Evergreening. Okay, that sounds deceptively positive, like gardening.
Right. It's anything but. Think of it like this. A student is failing a class. They have an F. But instead of giving them the F, the school says, okay, we'll just change the grade to incomplete. You can take the exam next year.
So on the report card, the student looks like they're still doing fine.
Exactly. The books look clean, temporarily. But the student is still failing. In banking terms, the borrower hasn't improved their business. They just bought time.
And the sources suggest this isn't just accidental. There's a political angle here, right?
We have to be impartial, but the reports are very candid. They indicate significant political pressure. Influential business groups benefit. The sources use the term willful defaulters.
Willful defaulters.
Yeah.
So people who can pay, but
well,
they just choose not to because they know they can get away with it.
Precisely. And in many cases, they retain control of their companies. So you don't pay the bank, but you keep the keys to the office. It creates a massive moral hazard. If you know there are no consequences, why pay?
That is the definition of a broken system. But the source material draws a sharp contrast between what's happening there and the India model. Because India had a huge NPL crisis too, right, around 2017-18.
They did. Their NPLs surged to over 11%. It was a massive crisis. But they implemented something called the Insolvency and Bankruptcy Code, or IBC.
And the key difference was?
The IBC allowed the banks to take control of the company away from the defaulter.
So if you don't pay, you lose the company. You don't get to be the CEO anymore.
Correct. It forced the recognition of losses. It was painful in the short term, really painful. But by March 2024, India's NPLs had dropped to 2.8%.
Wow.
Bangladesh, by contrast, is still relying on these money loan courts where cases just drag on for over a decade.
It's a classic case of short-term pain versus long-term pain. India took the hit to clean the system. Bangladesh seems to be pushing the pain into the future.
However, to be fair, the sources do point out a glimmer of hope. It's not all doom and gloom. Look at Sonali Bank.
Yes, I saw that. State-owned Sonali Bank. Despite the sector looking so scary, they posted a record operating profit of over 8,000 crore taka in 2025.
How? It's a mix of things. They reduced their default loan ratio to 15.4%, which is an improvement, and they're aiming for single digits by 2027. But also, banks in this environment often shift their strategy. They stop lending to risky businesses and just start pouring money into safe government treasury bonds.
Guaranteed returns.
Exactly. It stabilizes their own ship. It shows that recovery is possible if governance is tightened and banks actually go after the bad loans instead of just hiding them.
The lesson there is you can't just extend and pretend. You have to actually fix the governance.
Precisely. And I think that connects perfectly to our final segment.
Okay, bring it home. My head is spinning with global macro shifts and banking crises. How does this help the listener who is just trying to organize their wallet for 2026?
Well, think about the themes we just discussed. Controlled disorder, hidden debts, diversification. These apply to personal finance just as much as national finance.
We've got some great practical advice from Kennedy Mono and the Nomad's Diary channel. And I want to start with the biggest barrier for people. The excuse, I don't have enough money to invest.
Yes, the no small money mindset. Kennedy Yamano makes a great point. He says, don't wait to have millions. You can start investing with as little as 5,000 shillings or, whatever your local equivalent is.
Right, because the math of compounding doesn't care if the number is small or big, it just cares about time.
Exactly. But it's the structure that really caught my eye. We talked about how Bangladesh got into trouble by mixing bad loans with good ones and losing track. The Nomad's Diary 5 account system is designed to prevent you from doing the exact same thing.
I love this system because it assumes we're all human and kind of bad at math when we're emotional about money.
It removes willpower from the equation. Most of us have one big pot of money, one checking account.
Right.
And we try to mentally subtract bills, rent, savings. It never works.
Okay, let's run through the 5 accounts. Number 1, the bills account.
The boring one. Rent, insurance, utilities. This is non-negotiable. And here's the trick Nomad's Diary highlights. You do not have a debit card for this account. Or if you do, you cut it up.
This is the don't get evicted fund. You literally cannot access it for fun.
Exactly. Account number 2 is where the psychology kicks in. The swiping account.
My favorite, but also the one that scares me.
This is for variable spending. Groceries, fun, eating out. By separating this, you ensure that buying a nice dinner doesn't accidentally eat into your rent money.
I have to be honest, that hits home. I am definitely guilty of looking at my bank balance, seeing a big number and thinking, great, I can buy those shoes.
Yeah.
Completely forgetting that rent is about to create a crater in that balance.
We all are. With this system, when the swiping account hits 0, the hunt stops. You're eating noodles at home, but you're safe because your bills account is untouched.
Okay, account number 3, the safety account.
This is your emergency fund. Target 1 month of income to start, but also use it for sinking funds.
Sinking funds.
Predictable big expenses, school uniforms, Christmas gifts, car repairs. You know they're coming, so you put a little bit in here every month so they don't wreck your budget.
Number 4, the wealth account.
This is critical. Don't leave investment money sitting in a savings account. Give it a job. This is for stocks, bonds, or that gold we talked about earlier.
And number 5, the business or side hustle account.
Crucial for freelancers. You have to keep that tax money separate. Commingling business and personal funds is a nightmare. That's how you end up with your own personal hidden debt crisis.
So we have the structure. But what about the strategy? What goes into that wealth account? The South Indian Bank source raised a really important point about asset allocation.
They said the biggest mistake people make is asking, what should I buy? Instead of, what is my allocation?
Right. It's so easy to chase the winner. In 2025, if you asked, what should I buy? The answer was gold. In 2024, it was equity.
But if you just chase the previous year's winner, you're always buying high. You're reacting, not planning.
So for 2026, don't just dump everything into gold because it went up last year.
Exactly. You need a mix based on your age and risk appetite. You need some exposure to growth, like equities, even if they're wobbling. Some stability, like bonds, especially now that yields are decent. And a hedge, like gold. Don't bet the farm on one horse.
So let's try to synthesize all of this. What does it all mean?
We have a global economy that's moderating, a gold rally driven by a loss of trust, a warning from Bangladesh about what happens when you let debt fester, and a personal finance solution that says, separate your money, impose your own discipline, and don't rely on willpower.
It seems like the theme is face reality. Whether it's the U.S. stock market facing valuations, Bangladesh facing its bad loans, or us facing our own spending habits.
Absolutely. You have to face the numbers, not just hope they get better on their own.
Before we go, I want to leave everyone with one final thought from our source, Kai. We spend so much time obsessing over charts, gold versus Bitcoin versus stocks.
Kai's point is profound, and honestly, it's my favorite part of the whole stack. He argues that the best ROI often comes from investing in yourself.
It sounds a bit like a motivational poster, but break it down.
It's actually very practical. In a world where AI is changing work and economic transitions are happening faster than ever, your skills, your education, and your health are the only assets that no market crash can ever take away from you.
That's a great perspective. Increasing your earning potential is the ultimate hedge against inflation. If you get better at what you do, you make more money, regardless of what the S&P 500 does.
It really is. The best asset allocation includes you.
I love that. Thank you so much for tuning into this deep dive. We hope this custom stack of research helps you navigate the financial landscape of 2026 with a little more confidence and maybe a few more bank accounts.
Keep learning, and we'll catch you in the next one.
Bye for now.